Welcome to TradeTheNBI.com. This is John. This report is for the 20th of September. And well, moving pretty much as we described back here when we first saw the white NBI cross above our red, we knew that the market was in for a soft patch, particularly since we had already moved below the 33 levels of magenta as well as yellow and even orange at that point, and evidenced by the change in candle color from green. Plus below the ABM yellow, which becomes a very simple marker, particularly when it's between that 176%. We like that because it gives us that middle range in between. But once the magenta crossed above, the white crossed above magenta crossing right here, the expectation in the past had always been at least a move to the 50%, if not all the way to the zero. And so as we moved along in these days and even had some of these buybacks, I kept saying that still bearish was the viewpoint, considering still all we had was short-term buyers, which were what was holding things up for the most part. But that orange between red and magenta, cyan right here, is traditionally continuation, meaning continuation in the same direction, which has been to the downside. Has it been as extreme as we might have projected? No. I would think that some people would have thought that Friday's action was starting to get there, but when we're looking at these values, 50 points is still not that significant, nor have we reached the lows that we had in mid-August. Though at 50%, we'd be getting pretty darn close to that range. We've seen continuation of the dips below the yellow line, except for this last move on Friday dipped us back down, even though we had a slight pop up above. Again, that was mostly just that steel carry forward. Now, we're below negative 13 on our both red long-term buyers and mid-term buyers in the green. Did it dip below to a level yet? Literally we look for the red in the minus 20s to get a turnaround, kind of a medium bounce back. When it happens, it's usually from an extreme oversold. But in this particular case, you had a lot of short covering going on in between that. But turnaround back here of the orange suggests that you're not seeing a return to buyers just yet. Doesn't mean that we still can't get as much as a 50% return back into that dip from Friday. That would still be consistent with what happens in these kind of moves, but still representing itself as weak as the white returns back over that soft cross of magenta here. That was just the failing that. So if white continues to move back up, could see a significant move. Now, the one I'm also noticing here from the daily standpoint is the dip of the red NBI. Once we get below 1 and 0, we often do see a kind of bounce back reaction. However, that can take several days before it starts to spike back up. We could go back in time and see examples. You see it a lot intraday where they dip down, comes back up, and sometimes in broad sell-offs will remain in that negative category. But as soon as it moves back above blue, is when we usually start to say, okay, good likelihood. And all that represents for us in that particular case is to say, hey, if you've got solid gains on a short and you see a buy signal intraday, it's like, well, it's worth taking at that point. You can see from the NASDAQ standpoint, it was much stronger all along throughout this entire decline. Still is. Has even reached the 61%, whereas the S&P is getting closer to its 50. If you see more tech weakness coming through there, though, I think that move to the 50% for the S&P is inevitable at that particular stage. Of course, when big down days in that, we typically see sell-off in gold as people use the gains in that in there to turn around and cover exposure. And given the fact that margin has been what it is, that's where sell-off can become extreme because you have quite a few over-leveraged individuals given the low rates. And of course, you even just saw articles the other day where they're talking about trying to dog the dollar, so to speak, and try and push up other currencies because, again, it would help with S&P companies and the value. But the reality is in the Eurozone, you've got a lot of problems as far as any growth potential. And as long as there's the continued scare, the biggest threat is lack of tourism and fresh dollars coming into the European sphere, and so that makes demand for euros limited. And we definitely see the lack of tourism in places as relevant as where I'm in Florence here, just non-existent other than other Europeans. Very limited from an American side. And from an oil standpoint, again, we'll be watching that one because that would be the catalyst to really continue to drive the market lower. Continued rise in oil prices heading into fall and early winter would be catastrophic from an inflation standpoint. That would be the impetus, certainly, to dollar pressure, but that affects the world in general. That would not be a bonus for European Union in any stretch of the imagination, simply because it would continue to drive prices higher, and so that affects everyone. So if we go back to Thursday's action there, where we ended up with basically a fillback of all these positive extremes that happened, and that was right around that 44, 49, 46 range, and it filled partway back in at the start of the action, and then we ended up with this bounce. And you see on my little show me study here what this is. It represents areas where we get a spike of the weight above 30, and then of course it's just a matter of measuring the magenta in that, whether you get a spike clearly over it in that. In this particular case, it was just a classic white crosses red, and we've already had the dip of magenta under the yellow, and that below the 33 level. In this particular case, below the 25 was even worse for it. So even sooner could have entered into that one even before the pivot up. It just becomes more precise there, and sometimes a little more exacting than the DOC spread, which is the cyan and green crossing. If you get that red dipping down to another bar or so to happen, which is why literally the bar before it's early enough configuration. And particularly I like seeing orange writing above in a strong way. And with the expectation with that white over, when you have the peak is to the 0%. In this particular case, it went to the 0% anyway, which was literally just the fill of those positive extremes back to the zero. And you can see supported right on it and bounced. I mean, it's kind of a non-consequential number, but just below the, people say, wow, it was the 44.50. Not exactly. It was just a little bit below that. When we did get the spike, we had the previous white bump, and when that usually happens below the 50%, usually I'm a little bit more aggressive as soon as I get the crossover, and it's slightly higher. I don't necessarily have to see it dip below the red and then back above for to take that action, because usually you're getting a little bit more elevated price. And of course, it not only met the zero level, but broke down below and started the cascade. And originally I talked about, we mentioned in our Skype chat, around that 44.40 was sort of a confluence point for options and things like that. And since this was a big option expiration Friday, there was a lot of action taking place. And so once you get below there, it was really hard to get it back above that level. And as it continued to push, every single attempt at it failed. And as that builds, it just creates more selling pressure. And each of these white dots represents where you have the clear white spike above. Where it's red is when you have green, DOC, over the cyan. And you can see as we clearly ended up with those scenes, we ended up getting a lot of dips back to the zero. And this becomes relative to where prices and the amount of point movement that you can get. Sometimes when you get the signal and you're already at the lows, it's a little more what I would say suspect, because you have to be more on the defensive when you're already below the 23%, because you can't get turnaround spikes, even though in this case it did make new lows. Not significant enough of a move. Once we were up here at above the 23s, below the 38, that was pretty decent from a risk-reward standpoint. And the secondary one took place right here. Then we moved into the red dots, which was the green above, and then as soon as that DOC spread came through, boom, that's an opportunity, the expectation all the way to the zero. Give you an idea where that goes. So you're looking at 44.33 and the zero at 22. That's a good solid 16 points. That's exactly what it returned. So and then it gave even a little bit further on the move back down. And pretty much straight across in a lot of this little towards the end of the day month, but as soon as the end of the day came, a lot of that selling came through, and people who knew that they were going to get stuck with bad margin setups just sold off. So we'll see when futures open up here in a little bit. We were still in a little bit of continuation selling, and we were pretty oversold there, but not much change from orange standpoint, so we could see continued softness, and maybe they build that back up and get a P2, which would be a red DOC pivot that's higher, and that would be enough to turn around. But for now, still in the weakness standpoint. As always, though, I will continue to update the Skype chat and point out relevant charts. I'll throw up the 50K real quick just so we can see the pink bar attached. It had shorted within that. This was another one that I pointed out right here where we were above, all the way up at the 76% close here, and I was saying our expectation for that would be a move all the way to the lows. And so that was a significant call to say from, that 71 looking all the way to move down to that 25 range. That's exactly what it did beautifully. So very happy with the way that kind of configuration works. Trade well. We'll talk to you later.